Hello, welcome back to the Principles of Finance, and this is the second lecture in the financial statements. So, in our last um, video, we discussed, how return on investment is related to the financial statements, and we discussed, what is the objective function of the firm, and we understand that the objective function of the firm is to maximize profit, and the profit is the return on all the investors' input or the investment. In other words, capital provided to the company, right? So if you think about it, there are two types of capital. One is equity capital, and the other one is debt capital. Okay, debt capital is basically supplied through bonds, because you understand from the previous topic, you learned that the debt is bond is a debt instrument. So the way, one of the two ways that the company raises capital is through either debt or through equity. Equity is basically they usually call it owner's capital. What that means is the capital provided by the owners. Well, who are the owners? As I said in the previous video, in a modern corporation, there are numerous owners, right? And the owners can be institutional or individual shareholders, and the ownership is basically represented by the shares in the equity capital. So equity represents basically stock, right? Equity is the basically stock, and the stockholders are the equity holders as well as owners. And of course, as I said, the ownership is represented. Ownership is a collection of numerous investors, shareholders, right? And most of the shareholders are minority shareholders, right? And the majority shareholders, who owns, something like 10%, 11, 12%, all, pool their, there is a reason why, the majority shareholders pool together. There are those who, not all of them pull together. Some pull together against the other group. But the minority shareholders, what I'm talking about is minority shareholders are all anonymous, right? And so the profit is the output onto the input, which is the equity capital provided by the shareholders. But there is another type of capital, and there's also debt capital, right? Debt capital is also a part of the input, right? But then think about it. Debt, the providers of debt, in other words, debt holders or bond holders, right, have no claim in profit, right? Because they are not owners. They're not. Debt is not ownership. Debt is, what the creditors loaned out to the company. So, as long as in any case of loan, right? Just like in any case of loan, as long as the creditor gets their capital back with promised interest, then that's it. That's what the lenders do. That's what the creditors do, right? That's what the bondholders do. But the profit is the result, the final result after paying out all these interest and the lenders capital back to the lenders, right? So whatever is remaining belongs to the owners. Now, so the profit is the output, right? Output, against the input that was, the equity capital provided by the shareholders. If that's the case, the point is, what is the return on investment in this, in the case of, a firm? What is the return on investment? And how do we maximize the return on investment? Well, that question also is tied in together with how we maximize the profit. Now, so in measuring the return on investment in the firm, right, there are largely two measures: ROA, return on assets, return on total assets, and ROE, return on equity. Okay, so to explain this, we will need to go a little further, but here we'll start with the income statement. Why? Now, so it seems like, if you have no prior knowledge, in financial accounting, or financial statements, to be more specific, you might tend to easily think that everything in financial statements is all about profit. No. The answer is clearly no. Each financial statement has different purposes. The first, income statement, the goal of the income statement is profit, right? In other words, income statement is a description of the process that leads to profit. Okay, so income statement is about profit, but the balance sheet, the goal of the balance sheet is not profit. The goal of the balance sheet is capital structure. The goal of the balance sheet is describing the capital structure, or explaining the capital structure. Okay, so yeah. This. So they have different goals, let's move on to the income statement, right? So to explain the income statement, I will need to erase everything here. So let me erase, and then so income statement, as I said, is the full name of income statement is actually income and expenses statement. Okay. So it starts with listing all the sources of income, right? But there are largely two sources of income. One is sales revenue. Sales revenue. And the second source of income is investment income. Investment income. Investment income. Now, think about it. What do you think is the primary source of income? For any company, right? The primary source of income is sales revenue, because all the companies must sell something, right? Now, here's the interesting thing. I mean, some students may have already taken accounting, but when I ask what is revenue, there comes out all crazy answers, all free floating, freewheeling answers. What is revenue, first of all? Some people say, revenue is, what you get after subtracting cost. Some people say, no. But, people who say, oh, revenue is, I mean, let me give you an example. Suppose you're a computer manufacturer, like Dell Computer. Let's say you're making a computer. Let's say you are making Model X, right? And this Model X, to build this computer, it cost $300. Of course, to build a computer, what goes into a production of a computer? You will all say, oh, there's a CPU, memory chips, and keyboard. Yeah, we call that all of that. We label it parts and components. Parts and components, isn't that right? Parts and components, or raw material, right? Raw material, right? But that's not the only input that goes into the computer. There's got to be labor, right? There's got to be labor, right? Who puts them together? Who assembles all those, parts and components? Who assembles the materials? Now, is that the only thing? What if they use the robots? If you use the robots, then labor is can be minimized, right? If you use robots, what's that called? It's called capital. Okay. Robots or no robots, right? Still, even if it is intensively assembled by human labor, still the human labor will have to use some capital. The capital in this sense is physical capital. It's not financial capital, but physical capital. And the definition of capital, I don't know if you've taken any economics, but if you have taken economics, physical capital is the main definition of capital. Capital is something that serves to produce another thing. That's capital, right? So in other words, production equipment. I mean, even if it is all 100% automated by robots, right? If the company would, a manufacturing business would inevitably, it will have to have a factory, a plant, right? So the three inputs of production, or three factors of production, are capital, labor, and raw material or natural resource. Raw material or natural resource. Now, capital means in this case physical capital, so it means plant and equipment, right? Or manufacturing equipment, right? That's capital. Without capital, physical capital, there can be no manufacturing. Make sense? So let's say to build one computer, one unit, the input cost is all $300, right? $300. That means, a direct cost for labor, capital, and raw material, they're all $300. And then, of course, once the computer is built, you don't sell it for $300, right? That's stupid. So you sell it for $500, right? And that $500 is called what? Price. That's price, right? Makes sense? Now, so what is revenue? Revenue is when you sell one unit, how much do you receive? $500. Isn't it right? That's revenue, right? If you sold 100 units, how much is your revenue? Right? 100 times 500, right? 100 units times $500. So then that's going to be $50,000. If you sold 1,000 units, that's going to be $500,000. If you sold 1,000 units, that's going to be $5 million. So if someone answered like, after subtracting expenses, revenue is what's, left after subtracting expenses, then what does that mean? In this example, is it going to be $200? Is that the revenue? Huh? No way. If you subtract the expenses, then that means you're subtracting $300. Then you have $200 left. That is roughly the concept of profit, not revenue, but that's not exactly the net profit yet. It's just if you subtract only the direct cost, then it's called gross profit. Gross profit. But I'm not gonna. Okay, I'm gonna come back to that later. So here we can come to a definition of revenue. So what is the definition of revenue? So you already saw that. It's like $500 that you receive, for sale of your product, right? But then that's a verbal definition. The verbal definition is not a very smart thing, because verbal definitions always transform. It's like, everyone, I mean, even if I explain it to you verbally, right? And verbally, it's, what the payment you receive for, money you receive for selling the product, right? But then, once again, after time lapses, someone will say that, silly thing again. That, oh, that's what you get after, subtracting expenses. No. Why does this happen? Although we define it very clearly, right, in verbal terms, why does that continue to happen? Because people do not pin down their ideas in a very concrete terms. It's like, a phone. It's like a phone tag. What's that called? It's like a telephone game. When you were a kid, you probably played this telephone game. You line up like 10 people and whisper a message into the ear of the first person. And then you pass it on to the next person just by whispering in the ear. And when this message gets to the last person, you would have noticed the message has completely transformed into something else. And why did it happen? It's because people add their own interpretation every time. So it gets rephrased and paraphrased and rephrased and paraphrased over and over. So then the message turns into a complete monster, right? That open to interpretation thing, that's something we don't like in economics and finance or in mathematics. That's something allowed in liberal arts, like, literature, right? Open to interpretation. Well, beauty is in the eye of the beholder. Oh, what a very liberal. Uh, you may embrace. You love that idea. Beauty is in the eye of the beholder. Of course, it's in arts. It's very subjective, but in science, truth cannot be subjective. Truth is objectively. Truth is objective and objectively uh, congruent. In other words, there can be no. In other words, it's closed ended. It cannot be open ended, right? Something that everyone can agree beyond the shadow of even the slightest ambiguity. So, how do we define then revenue? It's simple. Think about it. What example did I use? I said, when you sold 1 unit, what's your revenue? $500. When you sold 10 units, $5,000. When you sold 1,000 units, 100 units, $50,000. Sold 1,000 units, 500,000. 500 units, 100 units, 1,000 units, $500,000. 10,000 units, $5 million. And if you sold zero unit, what's the revenue? Zero, of course. So what rule do you find here? What common rule do you find here? Wasn't it simple? Isn't it price times quantity sold? Price times quantity sold, right? Price times quantity. Isn't it right? Isn't it indisputable? Isn't it infallible? Right? There can be no argument about it. It's indisputable. Nobody will argue or dispute against it, because that's objectively the truth. That's objectively what it is. Nobody can, deny. Revenue is simply price times quantity sold. Right? Right. So that's so keep that in mind. Right? And it will, have linear characteristics because it increases linearly with quantity. Now, so that's the primary source of income. Secondary source of income is investment income. So think about it. When company has finally, what is the investment income? Investment income is like, interest from bond or, lending, and dividends paid from stocks. So it makes sense, what does the company do with the profit? There are two things that the company does, at the end of this process, then we will get the profit. Profit is like, you might say, so doesn't the profit belong to the owners? Yes, theoretically it belongs to the owners, but I told you, companies don't distribute the profit to owners. Isn't that right? Companies don't distribute the profit immediately after the operating period, each operating period. And what did I say? All the companies, they update their financial statements. How often? Quarterly. Especially, the companies that are publicly held or publicly traded. In other words, companies that are traded in the stock market, whose ownership is open to public, it's required by the Securities Exchange Commission, right? And I told you, Securities Exchange Commission is the regulatory authority in investment banking. In the financial market, it's right. Securities Exchange Commission is the regulatory authority, and it's the rule that all the companies that are trading, whose stocks are being traded in the stock market, must report, right, update their financial statement report, right? The filing of financial statements quarterly, which is called 10Q report, and also annually, which is called 10K report, right? So and then at the end of each operating cycle, you are the bottom line of this process is profit, and that profit that's not being distributed to the owners, and it doesn't have to be distributed to the owners. Why? Because companies need that capital. I mean, the profit is a source of new, capital that can be reinvested. I mean, company needs to, if the company is doing well, they will need to expand their production capacity, right? If they will need to open up new, probably, outfits, right? New, like Apple stores, right? Or their retail outlets, or all this requires capital, right? All this requires capital, and so so what is the source of that capital that they? I mean, the profit is the source of the capital that they can use for expansion. I mean, the profit may not be sufficient for the planned capacity expansion, but then if that's the case, they can borrow more or sell more stocks. But generally, profit is being used up for their own growth, right? Now, if they don't use it for their own growth, suppose their growth prospect is not that good. Their growth prospect is, at best, 3%. And if so, their, the return on their investment in growth would be, about 3%. And then what if they, and this is below the average market return. If this is below the average market return is, let's say, 8%. So then what kind of company, what kind of management would decide rather choose to invest in their own expansion over investing into the market and earn at least on average 8%? Make sense? So of course, the profit can be either, some of the profit, a part of it can be reinvested for growth, and part of it can be invested into the market. And if it is invested in the market, that means they are not investing. They are buying the stocks of other companies in the market that are doing well, right? The company, or buy bonds of the companies that are doing well. So that way they are. It's like using your, in case of personal finance, if you're using your own savings to invest in CDs or bonds or stocks, it's just like that. So from that investment, you get dividends and interest. That's called investment income, right? Okay, now then, expenses. Now, some people might ask, so what is, then what about rental income? If it is, think about it. Those are just, small subcategories of investment income. Think about it. The company can use their profit, invest their profit into the stock market or bond market or even real estate, right? Rental income is a kind of investment income, right? Just look at the big, broad outlines, minor subcategories. We can always, flesh it in or flesh it out later on. Make sense? The big skeletal structure, identifying the big skeletal structure is more important, right, than the minor, flesh part. Now, and also in expenses, there are two broad categories. One is direct cost, which is also called direct cost, which is also called CGS. Now, CGS is accounting terminology, and that stands for cost of goods sold, which is also called total variable cost. Okay? Total variable cost comes from, that terminology is microeconomics terminology. I'm going to come back to that later. And the second resource is indirect cost. Indirect. Which is also called OPEX. What does OPEX mean? It stands for operating expenses. Operating expenses. Okay? It's also called TFC, or total fixed cost, in microeconomics. Now, operating expenses is accounting terminology, right? Now, we're gonna, I'll have to cut the video here, and we'll come back to this in the next video. Stop.